All right, let's talk Capital One. Their latest earnings report. Wow. It wasn't just about the numbers. Not by a long shot. It was about a huge multi-billion-dollar bet they're making on the future of business payments. But you know what? The market's reaction was, not what you might expect.
So here's the big question, the puzzle at the center of it all. They announced this massive, forward-looking deal to buy the fintech company Brex. You'd think, wow, huge deal, stock's gonna fly, right? Wrong. The stock actually dropped. So we have to ask, why did this major strategic move get met with such a cold shoulder from investors?
And we're not just talking a little dip here. We can put a number on that skepticism. In after-hours trading on January 22nd, right after all this news came out, the stock fell over 3.3%. Some of the first reports had it down even more, over 5%. It's so clear that the market was way more concerned with what's happening right now than the future story management was trying to sell.
To really get what's going on, you've got to pop the hood and look at the financials for the quarter, because hiding underneath that Brex bombshell was a very, very mixed earnings report. And honestly, the whole story really just comes down to two key numbers. And here they are. It was a classic split decision. On the top line, the revenue, they brought in $15.6 billion, which actually beat what analysts were expecting. That's the good news. But, and this is a big but, the number that really moves the market is on the bottom line, adjusted earnings per share. They came in at $3.86, which was a miss of about 28 cents. And in this environment, a miss on earnings, well, it just carries a lot more weight than a beat on revenue.
So what exactly drove that earnings miss? Well, this chart right here tells the whole story. The provision for credit losses, that's the money the bank sets aside for loans it expects to go bad. It skyrocketed to $4.1 billion for the quarter. That is a staggering $1.4 billion increase from just the last quarter. For Wall Street, that's a massive red flag that says rising credit costs are a huge concern.
Okay, so while the market is digesting those scary credit numbers, Capital One's management is trying to change the conversation. They're rolling out this huge strategic announcement, one they hope is going to redefine the entire company for the next decade.
And boom, here it is. Capital One is buying Brex, a huge player in business spend management, for $5.15 billion. It's a 50-50 cash and stock deal, which is a massive investment aimed at completely changing the kind of company Capital One is.
So, why drop over $5 billion on Brex? Well, the strategy is pretty straightforward. This isn't just about buying a rival. It's about buying a whole technology platform. The goal is to hit the accelerator on their push into corporate payments, get their hands on Brex's really slick software and AI tools, and finally crack that national small business banking market they've been eyeing for years.
And you got to listen to how the CEO, Rich Fairbank, talks about this. For him, this isn't just another line item. He says it's a journey they've been on since day one. He's talking about becoming a company that's positioned to win where the world is going. I mean, that's not just business speak, that is a huge vision statement.
But this brings us right to the heart of the conflict for this quarter. You've got management telling this incredible long-term story about transformation, and it's crashing right into the market's much more immediate and, frankly, much more nervous concerns about the here and now.
And this slide just lays it all out, plain and simple. You've got two totally different stories being told at the same time. On one side, management is selling a payments and tech revolution with amazing long-term benefits. On the other side, the market is looking at its screen and seeing rising credit costs, knowing this deal will hurt earnings in the short term and seeing the huge risk of trying to integrate two massive companies, Discover and now Brex. It's a classic battle, long-term dream versus short-term reality.
So let's put all the pieces together. What in the world does this mean for the stock moving forward? It's time for our take. It's time for the next call.
Okay, here's how we're breaking it down. First, looking ahead to next quarter, we expect expenses to stay high because of all these investments. And credit costs, that is going to be the number everyone is watching. Second, because of that whole vision versus reality tug-of-war, we think the stock is probably going to be stuck in a trading range caught between the people worried about credit and the people excited about the tech. And that brings us to our final rating.
So after weighing everything, we are landing on a market perform rating. Look, the strategic thinking behind buying both Brex and Discover is really compelling. It could create a ton of value in the long run. But you just can't ignore the immediate headwinds from credit issues and the massive execution risk of pulling off two giant integrations at once. For right now, the risks and the rewards feel pretty balanced.
And as always, just a quick reminder, this explainer is for informational purposes only. It is not financial advice.